Greetings and welcome to the 2023 Finance Research Showcase hosted by the UTS Business School. I'm Lorenzo Casavecchia, the Associate Head External Engagement of the Finance Department at UTS Business School. It is my great pleasure today to welcome our audience, presenters, and industry guests. We appreciate your presence and engagement in today's event. Firstly, I would like to acknowledge that at UTS, we are on the land of the Gadigal people of the Eora Nation. So I want to pay respect to the traditional owners of this land, past, present, and emerging. As a reminder, we are recording this event for educational purposes. By participating, you acknowledge and agree to be recorded. Our showcase events are renowned for bringing together the finest academic and industry perspectives. Today, we have the privilege of hosting three accomplished UTS finance researchers who will share their recent empirical findings on fraud in initial coin offerings, shadow insider trading, and super fund regulation. To help our audience familiarize themselves with our presenters and industry guests, I invite each presenter to briefly introduce themselves, highlighting their backgrounds and areas of expertise. I would like to start with Dr. Kenny Phua. And Kenny, if I may ask you to please introduce yourself briefly to the audience. Thank you.
All right. Thanks, Lorenzo, for having me on the program. My name is Kenny. I'm a senior lecturer at UTS Finance. I do empirical research in corporate finance, peer effects, and most recently into forensic finance.
Thank you, Kenny. Our next researcher is Associate Professor Vinay Patel, who will present on the use of ETFs to conceal insider trading. Vinay, may I please ask you to quickly introduce yourself to the audience? Thank you.
Hi everyone, I'm Vinay from UTS. I'm an associate professor there and the undergraduate director of the finance program. My research focuses on market microstructure, corporate finance and derivatives, with particular emphasis on insider trading, and that's what I'll be focusing on in my presentation today. Thanks.
Vinay, thanks for joining us today. We look forward to your presentation. Our next presenter is Dr. Hulley, who will present on developments in the superannuation industry following recent regulatory changes. Hardy, may I please ask you to quickly introduce yourself to the audience? Thank you.
Yeah, so thanks very much for having me. My name is Hardy. I work in a large number of areas, probably mainly done most of my work in quantitative finance, and so stochastic models for things like short selling. But I've also worked in investment management with Lorenzo, and I've worked with some other colleagues in problems of corporate finance, like, for example, dual class share companies and so on.
Thank you, Hardy. It is my great pleasure today to introduce to you also Dr. Laura Ryan, who will provide valuable insights on the significance and research impact being showcased today. Dr. Ryan is an esteemed Honorary Industry Fellow at the UTS Finance Department. As the head of research at Ardea Investment Management, she brings a wealth of practical experience and strong academic foundation to our event. With her PhD training and extensive investment expertise, Dr. Ryan is the perfect sparring partner for our research today. Laura, welcome to the showcase. We look forward to your comments on the research to be presented. Thank you. Before we dive into today's exciting program, let's quickly review the format and some housekeeping details. For each topic, we will allocate 5 minutes for the presentation, followed by industry comments. And if you have any questions, please submit them through Zoom using the chat feature, and we'll do our best to address them during the last 5-10 minutes of the event. This simple structure will ensure a smooth and informative experience for all our attendees today. Our first presenter today is Kenny, and he will discuss the economics of financial scams, specifically in the context of initial coin offerings. I was surprised to read, Kenny, in your study that almost 50% of ICOs in your sample are scams or categorized as scams, amounting to over $14 billion in losses. There has been extensive media coverage on this phenomenon. The research delves into tactics used by malicious issuers to target naive investors and screen out sophisticated ones, ultimately shedding some very important light on the wider operational designs of scams and their implication on investor behavior. Kenny, the mic is yours. You have 5 minutes. Thank you.
All right. Thank you, Lorenzo. So really, when we began this project, we didn't just want to look at ICOs. We really wanted to understand how scams work in general, right? So I think by now, many of us over here would have come across some of these scams, right? Be it like email scams or phone scams, or even we might know people who are victims of scams themselves, right? So obviously, this is a very severe problem in our society. We know that there are lots of damages, there are lots of losses, and there could be like issues as well, because many victims, they are depressed, they become unemployed, and all of those bad stuff. So despite these consequences, we actually know very little how scams work. And the reason is, well, we rarely observe how scammers operate. Okay, so we kind of just know the headline numbers, but we do not know how they kind of craft their strategies, how they engineer their scams to maximize profits. Now, the second reason why we know so little about scams is that, well, victims are often too ashamed to step forward. So chances are that, those numbers that we see on the headlines are probably underestimated, right? Because many of these things go underreported. So if there's anything to kind of take away from today is, I hope to show you a little bit, how these scams work. So what are the economics of scams? Okay, so some of you might have received this email in your junk in your junk box. So this is the Nigerian prince email scam. So usually they will say, oh, I'm some sort of royalty, I'm stuck. If you could just give me like $1,000, I could give you part of my fortune, right? So this scam has been around for ages, and actually even dates back, like 2 centuries ago. Now, you might think like, hey, that's kind of weird, right? Because why wouldn't the scammer be more innovative? Why don't they use, more credible stories? Well, there is actually a rational reason behind it. And it is because the scammer wants to repel smart people. Okay, and the reason is, well, if they accidentally target the smart people could end up engaging the scammer, going back and forth, asking about instructions, so on and so forth. And at the end of the day, the smart people would just not give any money to the scammer, right? So the scammer's time and effort would have gone wasted, right? So the optimal strategy for a scammer is actually to get the smart people to immediately dismiss this thing as a scam, right? So maybe 99 people will do that. And the one person who actually respond to the scammer will likely be very, very naive, right? So that's why scams often contain cliche and, grammar and typo errors. All right, so the setting that we're going to use to kind of test this idea is in the market for initial coin offerings. For all purposes, you can think of them as like IPOs, but for the cryptocurrency market. Now, this market is larger than you might think. It has raised like more than $50 billion through 2020. And in our sample, we have almost 6,000 ICOs. And these ICOs, they will provide the information on what we call the listing websites. So these are unregulated, just places where the issuers can self-report the information of their ICOs. Now, what we find very interesting is that, well, 1 out of 3 ICOs have discrepancies in their information across the listing websites. And to the extent that this kind of discrepancies are material information for investments, then they might constitute misrepresentations under securities laws. So we're going to call them misreps for short. So here's our paper in one picture. Well, so if we sort, all the ICOs into 4 groups, the black line being low misrep and the red line being high misrep, we see that, over time, a lot of the high misrep ICOs are identified as scams, whereas not so much for the low misrep ICOs, right? So in short, misrepresented ICOs are more likely to be scams. Okay, and this really ties into the screening story that I told earlier about the Nigerian prince email scam, right? So they put those misrepresentations out there precisely to repel the astute, smart investors and to target really the most naive investors. Okay, so by our estimates, almost half of ICOs could be scammed, but most go unreported, more than $40 billion in associated losses. We also have a lot of tests to kind of knock out the idea that this is just carelessness or just poor ICO quality in general. All right, so some key takeaways. So we kind of highlight a rational screening strategy for scammers. And regulators mostly just kind of focus on awareness campaigns for now, right? So we think that that is kind of going on the defensive, which is nice, but potentially we could use kind of AI technology to help us go on the offensive, so we could like signal jam the scammers. All right, thank you very much.
Thank you, Kenny. Thank you very much for your presentation. And Laura Ryan will be now providing her industry commentary. Thank you, Laura.
Thanks, Lorenzo, and thanks, Kenny. So first I wanted to mention that I was, really fascinated by all three papers. And I think, each piece of research is really valuable reading for the regulator or policymaker in the relevant area. And I wouldn't be surprised if there were reverse inquiries requesting extensions of the research that's been done so far. In terms of Kenny's paper, so I thought what I'd do is just summarise what I thought were the really interesting points first. And the first is, I was left with no doubt that discrepancies most likely equal scams. And worryingly, a huge amount of capital is, being pumped through these ICOs by unsophisticated investors. And this is a market that's, really known for volatility and platform failures. And, this 34% number, this 1/3 having discrepancies across the information that's being advertised, that's a huge number. Without reading the paper, if you had have asked me what I would estimate, maybe 15%. So I think this 34% is, very alarming. And then really interestingly, in the paper, I don't think you mentioned this, Kenny, is celebrities are a reverse indicator for quality. So, I think that makes sense. Do the opposite of what Hollywood says. The other thing is, if you're trying to protect yourself, maybe look at the Deadcoins website that you mentioned in the paper, and then obviously check different sites. If there's a high degree of discrepancy across the different sites, then there's probably a scam ahead of you. And then finally, probably the most important thing is that there's no real regulation, and this is really concerning because this is a market that's clearly dominated by unsuspecting victims. So my first question is, how does geography influence the scamming?
Maybe, Kenny, if you would like to address one by one these questions with Laura. Thank you.
Yeah, sure. Thanks, Laura. So these are all fantastic questions that I'm seeing on the screen. I think it would be really, really interesting to kind of tie geography to the crypto market. But to my understanding, it is possible. And in fact, that is what the enforcement agencies are kind of doing. But it is kind of difficult from a data kind of perspective. But nevertheless, there are prior papers that show that other types of fraud, like financial advisor misconduct, tend to be concentrated in areas where they are more elderly people, they are less educated people, right? So we would believe that this would likely mirror the crypto market as well. But we wish we could do this. Thank you.
Thanks, Kenny. Now, you've also modelled a scammer's cost-benefit equation as well, and I noticed that you didn't include the future impact of regulation. Is that something you think would enter into the equation into the future, or what are your thoughts there?
Right. The model is heavily stylized to kind of emphasize the screening mechanism that we are talking about. Yeah, so we have a cost term over there, but that cost term is referring to the marginal cost of targeting, one smart investor. right? So I think the cost that you're talking about here is more like a fixed cost, if I could think about it that way. Now, I suspect that if we have that fixed cost, then that will result in like a blanket decrease in the scammers' profits. Now, perversely, this could cause the scammer to become, more discriminating in the way they do the screening, right? So, in fact, they may screen harder. They may come up with even, more outrageous kind of stories or misrepresentations just to repel even more smart investors.
Yep, that makes sense. So what do you think about the current level of regulation for what seems really like a market full of cowboys?
I get a sense that the regulators are trying very hard not to throw away the baby along with the bathwater. So, there are many people who are, calling for more regulations, but, regulations obviously will come with cost, right? And at the end of the day, we have to look at the welfare effect on society. So yes, while more stringent regulations could potentially reduce the scams, we also could consider that people are using these ICOs as a gambling device, right? And to the extent that these people would be burning money anyway at the pokies, is there really a true net welfare loss in society? So that really remains to be seen. But nevertheless, the large amount of losses that we have estimated could kind of figure into the way we talk about regulatory design for the cryptocurrency markets.
Yeah, I guess, and the amount that people kind of put through the pokies compared to what they might invest in cryptos might be a little bit different as well. Now, is it getting worse, Kenny? Do we have enough data to know if it's getting worse or better?
Right. Yeah. So our sample period was kind of an interesting one. It is one where there was a lot of uncertainty about the regulations. Regulators were basically not doing anything, like you mentioned, and there was just very little awareness. But over time, the market has matured a little bit, and in fact, we have more guidance now from the US and the European regulators. So they are increasingly after the view that, hey, these kind of tokens are really securities, right? So we have a very established test for whether something is a security or not. Yeah. So correspondingly, I think that the ICO market has kind of evolved as well. So these days they have kind of cleaned up their act. So I would think that things are becoming better. But beyond crypto, right? So I think the big picture of this paper is, beyond crypto, what we have highlighted is, in general, how scams work. And there's this idea that they are trying to screen their victims. So they are not just casting a wide net, because that is actually counterproductive, right? It actually reduces their profits. So they are actually being very targeted. They are being very, very strategic. Yeah, so I hope that's the key takeaway from this project. Thank you.
Well, thank you. Thank you, Kenny, for your presentation, and thank you, Laura, for your commentary. Kenny's paper has been recently presented at the American Finance Association annual meeting in 2023. Everybody is encouraged to look our researchers up. They are all on LinkedIn. Please feel free to reach out to them, download their papers, and engage with them in further discussion. Let's move on. Our second presenter is Vinay, who will present his latest findings on the use of ETFs to conceal insider trading, very important practice in the industry. On August 2021, the Securities and Exchange Commission filed the first lawsuit charging insider trading in a stock. A former employee of Medivation, a mid-sized biopharmaceutical company, was charged for trading on confidential information about the acquisition of Medivation at a significant premium. In his study, Vinay uncovers significant evidence of widespread shadow trading in ETFs. The findings hold significant implications for the future development in insider trading regulation. Vinay, if you are ready, please feel free to start your presentation. You have 5 minutes. Thank you.
Good afternoon, everyone. Thanks for tuning in. This work is with Elsa Eglite and Dan Stamans from the Stockholm School of Economics in Riga, as well as a colleague of ours, Professor Taras Putinen from UTS. So as Lorenzo rightly has introduced this topic quite well, so the article that I have on the left is a short snippet of, I guess, what Lorenzo was talking about. It's basically the recent and first prosecution case where the SEC charged an employee of Medivation Incorporated for using confidential information about his employer to profit from the trading of a stock in a competing firm called Insight Corporation. So insider trading involving trading in economically related firms such as business partners or competitors is what is referred to as shadow trading. So on top of that, the sort of secondary motivation for this study is kind of summarized nicely in the article that I have on the right of screen. And it's basically suggesting that ETFs can generate significant returns around price-sensitive news announcements. So the example here is that following Eli Lilly's acquisition of Loxo Oncology, ETFs which included Loxo Oncology as a constituent increased by 4 to 8% on the announcement date. So a specific example that I've pulled out here on the slide is the SPIDER S&P Biotech ETF with the ticker XBI. So the average abnormal volume in the sort of short-term 5-day period before the mergers and acquisition announcement was 2 million shares per day. And if you traded the XBI, the 6-day cumulative abnormal return was almost 10%. So sort of given that traders are implementing new strategies such as shadow trading to try and circumvent detection, and given that traders can earn significant returns from trading ETFs, in this study we try and expose a new type of shadow trading and look at how prevalent is insider trading using ETFs. So in order to try and quantify how much insider trading or shadow trading actually occurs in ETFs, we use a bootstrap method. And just sort of in a sentence or two, what is that? It's basically what we do is we proxy for shadow trading using abnormal ETF volume prior to M&A announcements. And we focus on the trading activity of sector ETFs only. So these sector ETFs match the sector that the target firm of the mergers and acquisition announcement. And we essentially compare the distribution of volume in ETFs, which are most likely to be traded by insiders, to the volume in a random bootstrap control sample of ETFs. So essentially, in one of our main tests, what we find is that shadow trading is quite widespread. We find abnormal increases in ETF volume in the short-term period before the M&A announcement dates in 3 to 12% of ETFs most likely to use by insiders. And from the specific ETFs that we've identified, we see that traders earn a significant and economically meaningful 6-day return or profit ranging from 1 to 11%. So this provides some evidence that one can profit from trading ETFs prior to price-sensitive news. And in particular, we find that this occurs in ETFs which are liquid, so that allows one to strategically trade or hide, but also in ETFs where these target firms represent a large portfolio weight in the ETF itself, and also target firms which experience large value changes resulting from the M&A announcement. So to put this all in dollar terms, so we find that a significant amount of shadow trading occurs during our 13-year sample period. We find that it totals around $3 billion and averages around $200 million per annum. But we note that our estimates are a lower bound estimate, as we only examined shadow trading prior to M&A announcements, and we know that there are a lot of other announcements that exist where shadow trading could occur as well. So I've just got two plots here on the slide to summarize some of our main results. So the one on the left is just a time series plot. It shows that shadow trading increases through time. This corresponds with increases in liquidity through time. And the pie chart on the right is basically showing that we find that shadow trading is most prevalent in the tech and healthcare sectors. And such findings are consistent with insiders having a greater information advantage in these sectors, for example, in firms with high levels of trade secrecy, or where the value of their private information might be larger, for example, in target firms which experience large announcement returns. So basically, overall, if only the traditional direct form of illegal insider trading is considered, then the total amount of insider trading may be underestimated, as it fails to account for significant levels of shadow trading. So our aim of our study is to guide surveillance efforts to reduce and acknowledge new types of insider trading, and with the ultimate aim of improving the integrity of financial markets.
Great, thank you, Vinay.
Yeah.
I need to just mindful of time. Thank you very much for your presentation. I'm sure that a lot of other additional aspects will come through the commentaries from Laura. So I would like to reach out to Laura now to hear her view on this research topic and possible economic implications of this paper. Thank you, Laura.
Thanks, Lorenzo. Yeah, while reading this paper, I started to think that regulators really are constantly playing a game of catch up. So I'd read Kenny's paper first and then yours, Vinay. So maybe I'm getting a little bit overwhelmed with negative information about scammers. But the things that stood out for me were that, 20% of merger and acquisitions are being targeted by direct insider trading, but the SEC is only catching a fraction of that. And then when it comes to ETF shadow trading, that's not even on their radar, and we know that these numbers are not small. And then what's worse is that because, as you've mentioned, ETFs are increasing in number, it means that shadow traders are going to find it even easier to hide and not be detected. So that's really concerning as well. And then lastly, this point that you made about the information asymmetry in industries that have a lot of IP, there's a lot more of an opportunity to profit from that. And then obviously there's going to be a lot more shadow trading. So what's next for this research, Vinay? Can you, more broadly apply this research? I really think there'd be quite a number of regulators across the globe that'll be interested in an extension of this research, not only in terms of the region, but also into, different securities as well.
Yeah, thanks, Laura, for taking the time to review the paper, and appreciate your comments and questions as well. So yeah, our approach is a general approach and really can be applied to other settings, other regions, other ETFs, other markets. And as he's rightly said, uncovering the amount of shadow trading that occurs across these different markets would go a long way to really understanding how much of this stuff actually happens. So I think, as I sort of mentioned before, we look at shadow trading prior to M&As only. So we're sort of planning to extend this to look at other major announcement types like earnings, as well as other countries. And all of these types of things will give us a better sense as to what's actually happening. So yeah, as you said, if there's any regulators out there that are interested in understanding our methodology, please reach out. We are working with one of the regulators now to see how this work can aid the enforcement efforts. So always open to looking into other markets and other countries as well.
And do you have any idea about what the kind of average shadow trader looks like? Where are they? Do we know what their background is? Is there any information on them?
So yeah, I guess, at this stage, the best we can get is a good insight into sort of who the average shadow trader is. Look at the prosecution case that Lorenzo mentioned earlier. In this case, it was an employee of Motivation Incorporated, and they had private information about their company, and then they used that to trade in another company, and as a result of that other company, Insight Corporation, becoming a more attractive target, they were able to profit from it. So I guess at this stage, without the more prosecution evidence or cases, it's going to be a little bit hard to try and identify some of these characteristics of the shadow traders themselves, but it's definitely something we will be keen on looking into. I guess so far, some of our major findings are, we know where it happens, but it'd definitely be an interesting avenue to identify some of the individual characteristics as well.
And I work for a fund manager, and so there's very strict rules about when I can trade and what I can trade personally. Do you think, I don't really have an idea of what the trading rules are across other industries. Do you think that the onus should be put on employers to make sure that their employees are not able to participate in this, or do you think that this is a regulator's problem, or both, or how do you think we should work to fix it?
That's a good question. I think ultimately both sides of the coin could probably do more to help reduce illegal trading, because obviously no company wants to see illegal trading in themselves for reputational reasons. The regulator doesn't want to see it either. There's rational crime theories that exist, and these theories suggest that no rational individual would conduct insider trading if the detection rate was too high. So ultimately, if everyone can come together to ultimately increase the detection rate, then this may discourage or reduce illegal trading. But as I think sort of Kenny was alluding to as well, that we know that some of these guys, they're overconfident, or they have incorrect beliefs about detection probabilities. So it's difficult to eliminate it completely. But I definitely think both sides could probably help contribute to helping reduce the overall levels of illegal trading that we see.
Okay, and what's next for the shadow trading? They just seem to be, well, I can't do this anymore, I'll do this instead. So what do you think? What do you think's next on the radar?
Yeah, I mean, some of them may be watching now. But, I do know that these guys are clever and they're sophisticated, and the evolution of financial markets sort of helps them naturally. We see that the introduction of new ways for insiders to trade and get exposure to their employers or business partners or competitors provides more opportunities for individuals to trade strategically. And we see this, right? We have the stock market, there's many cases of inside trading in there. And then we introduced the options market and they went there as well. And then my research is suggesting that it's occurring in ETFs as well. So it's really a problem. As financial markets continue to evolve, it becomes trickier and trickier for regulators to stay on top of everything. They're also resource constrained as well. And, just growing number of assets, growing number of markets makes it really difficult. So it's just a really tricky problem to keep on top of.
Fantastic. Thanks to Laura, first of all, and thank you, Vinay, for presenting your interesting finding. I should have said that we are twin-casting both on Zoom and YouTube, where we have about 150 people, maybe all ETF, all ETF investors there. I should mention that Vinay's paper received extensive media coverage by Financial Times, Bloomberg, and the Australian Financial Review, and it was captured by the Columbia Law School. So I guess there is something happening in the law realm. So that is, to me, the definition of research with impact. Thank you, Vinay. Great work. I would like to move to the last presenter. So we now change gear and look at something closer to us, the superannuation industry in Australia. As many of you are probably aware, the recent Your Future, Your Super legislation is a significant reform in the Australian pension system, and is trying to enhance the efficiency, transparency, and accountability of our superannuation sector. However, like any major policy reform, it is crucial to examine the potential unintended consequences that may arise from this implementation. Ardea today will provide an overview of these unintended outcomes, delving into the economic implication of the legislation. Ardea, please feel free to start your presentation. You have 5 minutes.
So thank you very much, Lorenzo. So, yeah, I mean, this is work that I've been got involved with a number of colleagues, and yeah, we've become very interested in the impact of this Your Future, Your Super regulation that was introduced in 2021. And yeah, we recently wrote a submission to Treasury about the regulation as a review that was currently still being conducted of that regulation. And I want to highlight a couple of things that we found that were really quite interesting. So, you know, before I start with the results, just a quick overview of what the regulation is. So the fundamental thing is that there's a performance test. And the way the performance test works is that every fund is measured, it has its performance measured relative to a benchmark every single year. And the benchmark is based on a set of indices for different asset classes. And if that fund underperforms its benchmark by more than 50 basis points over an 8-year rolling window, then the fund is forced to write to its members and disclose the fact that it has failed the test. And if it fails a second time, then in actual fact, the fund is closed to accepting investment from default members. So a couple of things that you know, sort of struck us about what could be the impacts of this test. So the first thing was that when you look at this test, you have a relative performance. So you test in the relative performance of a fund relative to benchmark, and you have a pass-fail threshold. So this thing looks like a put option. And in effect, it looks like the funds now have a short position in a digital or a binary put option on their relative performance. And we know that if you've got a short position in an option, you want the option to have as low a value as possible. And the one way you can do that, the only way you can do that, is to reduce the volatility of the underlying, which in this case is the tracking risk. The tracking risk, which is to say the difference between the performance of the fund and the performance of the benchmark, that is what's going to increase the probability of failing the test. And so what this has done is that, or what we hypothesized this would have done, is that it would have caused funds to focus all their attention away from actually delivering good outcomes to their clients or to their members, and focus their attention on actually not failing the test. And if you go on to the next slide, Lorenzo. So this is the evidence that we saw of this, sort of in a nice diagram. So the top half is you're looking at the funds that passed the test, and you're looking at the asset allocations prior to the test. And what you see is that these funds were heavily invested in things like property, infrastructure, unlisted equity, which were assets that delivered really, really good returns, and they had relatively low investments in listed equity. The problem with these assets like unlisted equity and infrastructure is that the tracking errors are very, very high. And if you're concerned about failing the test, these assets become very unattractive. So what we see then is after the test, which is the bottom half of the diagram, after the test, what happened is these funds dropped their investments substantially in infrastructure, property, unlisted equity, and basically upped their investments in cash and in listed equity, which is to say that they've become indexes. They're really just investing in index. They're investing in the assets where they can get a zero tracking error because they just want to minimize the probability of failing the test. The other thing that we also noticed, if you go to the next slide, is that the probability of failing the test doesn't really have anything to do with performance. It has just to do with the demographic of the members in the fund. Here we see the funds that passed the test or the funds that failed the test are zero. So all the funds what we're seeing is the demographics or the age profile of a fund relative to funds that failed the test. And we can see that funds that passed the test had 10% less members aged 65 years or over. They had slightly less members between 45 and 65, and they had more members that were younger. In other words, what's the best predictor of whether you're going to pass the test or not is that having a young demographic. Why is that? Well, the reason is because the funds that had older members essentially were doing good practices. They were investing in portfolio insurance. They were investing in defensive assets. What's wrong with that? Portfolio insurance, defensive assets, high tracking errors. And therefore, a lot of these funds ended up failing the test. So this is probably the most serious indictment of the test, in my opinion, is that superannuation is a retirement product. It's a product for people wanting to retire. And yet what this legislation has done, what this superannuation test has done, is it's punished funds for managing according to the needs of an elderly population. And the net result of that is that we have this relative performance measure, which is more or less irrelevant when you're talking about people retiring. And we have funds being pushed away from doing things that are sensible when it comes to managing according to the age of their members. Anyway, I think that's enough for me now.
Thank you, Hardy. Like to jump to Laura. So handing it straight over to you, Laura, for your commentary. Thank you.
Thank you. Yeah, so I've read quite a few critiques of your future, your super measures, and almost all of them are not positive. But I think that, this particular piece of research had some key images and phrases that I think really put things into perspective, and they were done in a really, really powerful way. So the first really strong point that was made in the paper is that, Hardy's just spoken about this, is that the objectives have shifted from the traditional goal of trying to achieve risk-adjusted returns, the best risk-adjusted returns for members. And now the goal is don't fail the test. And, just to reiterate Hardy's point, the goal of superannuation is meant to be about the members and achieving the best outcomes for retirement, not for super funds trying to not fail. So that's a real problem. And then some of the other really clear points that were made in the paper were, as Hardy's shown, is this huge shift in the strategic asset allocation before your future, your super, and then after. And this other point that I think, giving people the opportunity, or members the opportunity, or even other investors in the market to, game the system, because there's some pretty easily absorbed information about whether a super fund's going to fail or not. It's pretty high probability that you'll guess correctly if they've already failed it on the first test. And then, this intertwining of fees and performance that doesn't really make sense, and as was pointed out, doesn't have any academic justification. That's worrying, and it looks like it wasn't done with consultation with the industry or any experts. And then there was this very, very powerful image in the paper which showed the shift in the efficient frontier to a much, much more inefficient spot. And, that chart by itself, I think, is really, really powerful. And, I think probably should, lead the discussion whenever there's this topic's being discussed. You've just had this, terrible outcome in terms of super funds now targeting an inefficient strategic asset allocation. And then, lastly, there's this problem in that the less sophisticated members are going to be penalised because the more sophisticated members will be able to spot that, it's probably likely that the fund will close down, and then they'll get out early, and then, the members left in the fund will then probably suffer from the issues with respect to illiquidity and, just less favourable outcomes. So, overall, it's really difficult to see how this test is doing much good at all. So, Hardy, you mentioned that this test and these new measures mean that super funds shy away from investing in illiquid assets because of the lack of the benchmark there. But there's also the issue of those asset classes not being marked to market as frequently. And so you get this smoothing effect in terms of the returns. Did they look at that? Did APRA look at that as well in their analysis?
I haven't seen that looked at specifically, but I do know from speaking to several people in the super fund industry and in the investment management industry more generally that this is acknowledged as a problem. And so for example, one case of it that I know of is where commercial property in big cities, throughout COVID, what happened is that, and immediately after COVID, is that there were massive drop-offs in occupancy, and this meant that implicitly the values of these properties had to drop. But nobody wanted to revalue these properties. Nobody wanted to revalue any one of them, because if you did, you'd have to revalue all of them. And so there was a sort of a quiet consensus, if you like, among people that held these assets just to keep the values as they were, and nobody moved first to revalue them. So yes, you're 100% right, and it is a problem. I mean, some of these assets, unlisted equity, for example, should be a very risky asset. And what we see is very high returns and generally quite low volatilities, which doesn't make sense. But it's difficult to know exactly how. I mean, there are ways, but it's difficult to know exactly how you're going to account for risk properly with these kinds of assets.
Thanks. Do you think that APRA is hearing everyone? So across the industry, it receives very little support, and I think the fact that there's papers being written by you in academia, and academia tends to be a little less self-serving than us in the industry. So I think this is a big red flag. Is the message getting through?
I'm not entirely sure it is. I mean, to begin with, I suspect that a lot of the impetus for this is political, and that this is one of that there is a view probably on both sides of politics in Australia to thin the herd when it comes to the superannuation industry. And it's one of the few things that both sides of politics agree on. And so it feels to me like the real motivation for this is ideological rather than anything else, in which case the nature of the test and so on is more or less irrelevant. It's just a mechanism to reduce the number of funds for reasons that have nothing to do with performance.
So maybe I'll ask you about question 5 first before question 4, because it relates to it. So, if we've got this test which is designed to reduce the herd, what does it mean in terms of stability for the financial system if we end up with a couple of super funds? Is this a big risk?
So it's hard to know. This is the big problem. I can think of several plausible problems that could come out of it, but of course there are also problems that can come out of having too many small funds operating. But I would say that if you don't understand the system very, very well, in general, moving in a direction that's opposite to diversity and opposite to diversification, opposite to choice, and putting more and more eggs in a smaller number of baskets is in general a bad heuristic. So unless there's a really good reason for this, I'd say that it's probably a risky thing to do. And in particular, since we're dealing with an aging population, and that's going to impact on the objectives of the superannuation industry, and it's going to impact in a big way on the liquidity and the ability to invest in illiquid assets. You have to say that if you put everything into a small number of mega funds, how are they going to be able to operate in the best interests of a particular demographic? I mean, it might be better to have more and more specialized funds that sort of cater to different risk profiles and different age characteristics and so on of the population.
Thanks. And a little bit more of a self-serving question. So what do you think this means for innovation for fund managers? You know, if our incentive is just to go to the benchmark, then
I mean, it's clearly it's anti-innovation. I mean, the message is that, I mean, if you're going to innovate, it's costly, and the message is that the legislation is implicitly and in fact explicitly hostile to management fees. So the argument that's being made between the lines is that what money managers can do, what they can do through innovation and so on, is not worth what they need to charge for it. So I think it's going to be, I think it's bad for innovation.
Thank you.
Fantastic. Thank you very much, Laura, for all your great comments to Hardy, Vinay, and Kenny. And Hardy, terrific. Thank you for your presentation and being perfectly on time. I'm just conscious of time and looking at the chat. So the fact that there are no questions in the webinar chat or in YouTube makes me think that, Laura, you really addressed some of the most pressing questions from the audience too. So I would probably leave it at that, given that we are very close to the finish line. So as we conclude this riveting research showcase, I would like to acknowledge the incredible contributions from our great presenters, Kenny, Hardy, and Vinay, and the invaluable insights provided by our industry fellow at UTS, Dr. Laura Ryan. Although we'd love to delve deeper into these fascinating topics, time constraints call for a wrap-up. We encourage you to connect with us on LinkedIn and explore our YouTube channel for interesting content from past events that cover many, many different topics. On behalf of the UTS Finance Department, we would like to thank you for your participation and wish you a great weekend. We look forward to seeing you all at our next event. Until then, thank you and take care.